Howdy, friends. Is the death of the 60-40 portfolio around the corner? What about if you are picking funds by the stars? Are you doing that? If so, you may want to listen to today's program. That, plus, unfortunately, we've got some bad news for small investors about a trend in the financial services industry that continues to pick on small investors disproportionately. So we'll talk about all that on the program. Plus, we'll get started here with a little bit of a conversation about the futility of trying to predict the future. Doesn't that make sense? Isn't that pretty futile exercise when you're trying to predict the future? Well, we'll talk a little bit on the program this morning about that. Welcome to the show. This is, of course, Dollars and Cents. We happen to be Central Florida's longest running radio program, now in podcast format across the various different types of channels. To simply find your channel of preference, you can obviously go to the particular channel that you like, whether it's iTunes or Google Play or whatever the case may be, and you can search for Nelson Financial Planning and you can find us that way, or you can go to our website, nelsonfinancialplanning.com, and then in the upper right hand corner you'll see like 10 different icons. Click on the one that's most familiar to you and you'll be immediately directed over to the audio version of the program. To see us live, well, it won't be live because it'll be on the internet and it'll be a video taped. To see us, though, in full living color, we've got a little bit of a holiday tie on today. So if you want to see the tie selection, you have to go to YouTube where you see the video of the program, our YouTube channel, very simply Nelson Financial Planning. So that's how you can engage with us on the program to hear all of what we've got to talk about today. So let's begin. The futility of predicting the future. Seems pretty straightforward, right? It's a pretty futile exercise, but this time of year is when everybody, well, including ourselves, because we also do a little bit of a tongue-in-cheek exercise called the Fearless Forecast. We've been doing that now for 20, maybe longer years. I remember when Jack and I were doing the show where we would often come up with our Fearless Forecast and make sure that we weren't comparing our notes or anything like that, where we would come up with sort of our tongue-in-cheek exercise independently of each other. Now it's just me coming up with the exercise, and it is a bit futile. It is a bit tongue-in-cheek, but every year around this time, you hear people making predictions about what the next year is going to hold. Of course, we'll fall into that trap as well in our first program for the year 2020 that's coming up, I guess, if I got the calendar correctly, in about 3 weeks. And so we'll do that, particularly since this past week I got a Christmas card from a loyal listener reminding me of what the prediction was that I did at the beginning of this year. And actually, it looks like we're coming in pretty close. But it is amazing how much people fall into the trap of thinking that they're going to move their money in and out of the market in reaction to those short-term swings, to the basically, if you're in an investment program where you're going to get out of the market during certain periods of time and get back into the market at other periods of time, I don't care what they're calling it. I don't care how they're describing it. I don't care how they're putting lipstick on that pig. It is still a pig. And at the end of the day, your investment results are simply not going to be as good as they could have been had you just been consistent over time. But yet, many people fall into that trap and somehow think that there's some magic formula that allows folks to move money in and out of the market. Folks, it just doesn't work. It's been tried again and again and again, and on a consistent basis, it means that you're out of the market during periods of time. And what most people don't realize is that the market, in fact, makes the majority of its move within short periods of time, both to the good and to the bad. So when you get out when the market's going down, what happens is oftentimes there's a very quick recovery that follows that. And if you're sitting waiting, well, you miss the recovery. And that's how your underlying return gets affected over time. Look, big money managers get this very wrong all the time. One of the biggest money managers out there, he's now retired, is a guy by the name of Bill Gross. Used to work and run the world's largest bond fund out of PIMCO, left them. I think he went to Janus, if I remember correctly, and eventually he retired. But Time Magazine had an article back from November of 2012, and that article was titled "The Death of Stocks." That was the title of the article. It was titled "The Death of Stocks," and in it, this very famous investment manager is predicted as says that stocks aren't going to do anything for the next several years, and it's all doom and gloom, and you're never going to be able to get much of a return. The problem is, of course, at the time the Time Magazine article was written, the S&P 500 stood at 1406. Again, remember the title of the article, Why Stocks Are Dead. Market sitting at 1406. Today, that same S&P 500 is sitting at 3146. If I'm doing the math correct, that's about 2.5 times greater than what the market was at the time the Time Magazine article came out in November 26 of 2012, titled Why Stocks Are Dead. Isn't that kind of fascinating, right? Time Magazine quoting one of the biggest money managers in the world at that time, why stocks are dead. Well, they're dead, but they still returned about 250% return since that period of time. Market at 1406 versus 3146 today. That's a pretty significant difference in terms of the performance. And perhaps stocks really weren't dead during that period of time. So you see the trap that you can easily fall into in thinking that somehow you're going to predict the future, you're going to be able to do this. But yet at this time of year, a lot of folks in the financial services engage in that. We would caution you to be mindful of the futility of predicting the future. However, as a loyal listener reminded me in a Christmas card he sent me this week, we're actually on track for being relatively accurate this year. Our prediction at the beginning of the year was that the Dow would close for the year, the calendar year, at 28,400. Well, here's the crazy thing. The Dow closed on Friday at 28,135. So we're pretty darn close to where that number may very well wind up. We still got another couple weeks to go, and so we'll see. But interestingly, we're closing in pretty close on that number. It's funny, as I looked at our predictions over the years, and we do keep track of them just for curiosity and conversation's sake, if the market were to close at that level that it closed at Friday, and that would mean that we would be basically within 250 points of our fearless forecast versus where the market wound up. Interestingly, over the past 7 years, 8 years, we've actually been closer than that 3 times. In 2012, we were within 400 points. 2014, we were within 200 points. And 2016, we were within 250 points. So that's kind of, and then now 2019, that's 4 out of the past 8 years. That's 50%. That's getting that close. That's not too bad at the end of the day. But remember, when we engage in that exercise, much like the rest of the industry engages in that exercise at this time of year, it is a bit futile to predict the future. But yet, we often see so many people engaging in that, believing that they can time sort of the ups and downs of the market and understand what the future holds. And folks, that's where we would encourage you not to do that, because the reality is that investment results are achieved by being consistent over time. And there's a gazillion studies out there that support that statement. There's a gazillion studies out there that also say that if you're trying to time the market, it does not work. So be careful of that. And also understand that this time of year, as you hear these forecasts, as you hear these discussions, remember, they're going to be all over the place. That Time article from November of 2012, Why Stocks Are Dead, that wasn't really, I mean, at Time magazine, that's a publication that is viewed pretty broadly as an expert publication, and lo and behold, not even close to what actually transpired over the next 7 years. So be careful of what you hear in these days. So with that, we'll take a break. When we come back, we'll continue the conversation. We're going to sadly share with you the continuing bad news for small investors in the financial services industry. We'll talk about what that means and how you might be able to address that if for some reason you don't have $500,000. We'll talk about that next here on the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. So have you been affected by this ongoing trend in the financial services industry? You know the trend that we're talking about. It's this constant conversation, whether you see in the ads or in print or on radio or on the internet or on television, that says, if you've got $500,000, we want to talk to you. Well, did you ever stop and think about, well, what if I don't have $500,000? What if I'm just starting out? And here's the statistics on it. When you look at younger generations, whether it be the millennials or the Gen Xers, they're behind schedule in terms of where they should be relative to their peers from 30 years ago. We talked about that on a prior program, where the latest calculation on that has them as much as 40% behind their peer group. And unfortunately, we constantly see and hear that message of, if you don't have $500,000, then we don't want to talk to you. And that's throughout the financial services industry. Now, it's even getting to the point where that threshold is driving what actually is happening in the industry in terms of the compensation that advisors are paid. The latest to come out with this is a large bank. We're not going to name names on the program because we don't do that. But a large bank came out this past week and put out its compensation grid for its advisors and basically said that we're going to penalize you if you have accounts that have less than $250,000 in them. Well, again, how does that help? How does that help the young person or the folks that are just starting out to try and save money for retirement? If you can't access services that are available to others, how on earth is that fair? And when you look at the numbers and the statistics in terms of how much the percentages are in terms of how some of these generations are not doing very well at getting started for retirement. If you just think of like the Gen X's, which are generally folks that are born from like the mid 60s on up to the 80s. So that's the generation that is older than the millennials. The Gen Xers are in tough shape when you look at their overall retirement savings. Nearly half don't even have a retirement savings account. The millennials, in fact, which is the generation that follows the Gen Xers, the millennials are actually doing a little bit better than the Gen Xers are in terms of the overall ability to have started and to have saved for a retirement account. The problem is that we see in the financial services industry where more and more, if you don't have a big chunk of money, but here's the thing, wealth, unless you're lucky, unless you win the lottery, unless you're born into it, wealth is frankly achieved over time. It's not something that just all of a sudden magically falls out of the sky unless you win the lottery or you're born into it. For the rest of us, we've got to accumulate it over time. So this notion of only talk to somebody in the financial services industry, only talk and use the services of an expert, if you've got $500,000, it just seems quite silly when you stop and think about it, because the reality is that there are younger generations, millennials, Gen Xers, that most of them haven't, or nearly half of them, haven't even started a retirement savings account. So our conversation and our message today is to talk to that group of people that are just getting started, and maybe they may be a little bit older, but the reality is you've got to start now. And so we're going to give you some things to be thinking about, particularly here at the end of the year, looking into next year. It's always a great time to make resolutions and what you can do differently. And we really want you to think about what you can do differently in terms of saving for retirement. These numbers are abysmal, and the financial services industry is doing a horrifically bad job at promoting the ability to save for retirement and actually helping people do what they need to do in order to save money for retirement. So one of the first key things that you should be doing to get started for your retirement is look at the options that are most likely already available to you. Chief among those is what your employer offers. Your employer probably offers some type of retirement plan, whether that's a 401k, 403b, 457 deferred comp, a simple IRA. The list goes on and on. There's a variety of options out there that employers offer. And what surprises me about the conversation when we talk about, okay, well, what does your employer offer? We often hear a couple of things that just kind of leave us scratching our heads. They may say, well, my employer doesn't match anything, so I'm not doing anything into that plan. This is about your retirement savings, and there's nothing simpler when it comes to an employer plan to set something up automatically for any amount of money, for low dollar amounts to just get started, because the reality is those small dollar amounts accumulated over time grow to bigger sums of money. So it is imperative that you don't use that excuse of, oh, my employer doesn't match, so I'm just not doing it because they don't feed it any money. Well, you can feed it money. And there's nothing more easier or more convenient than having that money taken out of your paycheck. This time of year is the time of year where typically people get bonuses, people get employee reviews. I know we just did that at our operation. And so what comes with that is usually some level of a salary bump or a salary increase. And so you need to take that increase in your paycheck and ultimately pretend it didn't happen and use that to put that money into your employer retirement plan. That's the easiest, most convenient, simplest, low dollar amount. It doesn't have to be big dollars, but the importance is to get started and to get started sooner rather than later. So that's one objection that we often hear. The other thing that we often hear is, well, I'm doing 4% because that's what my employer matches. Like, I'm not doing anything more in order to get the match. Well, wait a minute. Again, it's still your retirement. So what you really should be doing is doing as much as you can. And yes, certainly, the threshold that you at least want to do is to do enough into that employer plan to get the employer match. But folks, that's the minimum. That's not the maximum. That's the minimum. Don't use that to determine how much money you're going to put into a retirement savings account at work. Don't use that as the threshold. Use the better threshold, which is how much can I really afford to do? If I look at my budget carefully, if I look at the numbers, how much can I afford to do? The minimum you want to do is what the employer matches. But you've really got to go beyond that, particularly like most Gen Xers or millennials, you're having to play catch up. If you got half of that age group that doesn't even have a retirement savings account, that's a lot of catch up that they need to do. So rather than look at it from, oh, I'm just not bothering with my employer plan, or I'm only doing the match, really look at how much you can do. And in particular this time of year, when you get those salary bumps and you get those pay increases, just pretend they don't happen. Just take all of that and then correspondingly put that money into your employer plan. Now, if your employer does not have a plan available to you, then there are other options that are very simple to set up. An IRA, or depending upon your tax bracket, a Roth IRA. Those types of accounts can be set up for as little as $25 a month. So if your employer doesn't have a plan, the next thing you should be doing is saying, okay, let me get an IRA or a Roth, depending upon my tax bracket, and ultimately I'm going to start to save money. And those you can do for as little as $25 a month. You can find $25 a month. The point is that you need to get started, and just get started for any amount, because the reality is that you've got a lot to catch up, particularly those younger generations. These numbers that are coming out just are abysmal at best. And so, much like we said on a prior program of 3 or 4 weeks ago, millennials wake up and smell the coffee. It's also the Gen Xers wake up and smell the coffee, because nearly half of them don't have any type of retirement savings. So make sure that as you go into the new year that you take advantage of that, and you don't use those tired excuses of, oh, my employer doesn't match, or oh, they only match to a certain level. Don't make it about that. Make it about as much as you can afford, putting a little away each and every paycheck. That, folks, is how you get to accumulate wealth over time. Sadly, the financial services industry as a whole is going more and more to a model where they are ignoring that group of people, and we think that is shameful. And at the end of the day, those people also need to be saving money and not just get the services if you've got $500,000. That's ridiculous. It's about time in and getting started, much more importantly than that. So make sure you're doing that, particularly as we go into a new year. Just a disturbing trend that has been going on for a number of years, sadly, in the financial services industry. We're going to slide to our break. When we get back, we'll continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Howdy, folks. Are you star picking? Do you know what that is? Right? There's a bunch of different rating services out there, whether it's Morningstar or S&P 500. The list goes on. There's a ton more than there ever used to be, that's for sure. And what they do is they, put some stars on the funds or some other type of metric. And a lot of people out there, when it comes to deciding which funds to own, believe in stargazing, believe that, oh my goodness, I've got to have a 4-star fund or a 5-star fund, and that ultimately that really is how I'm going to construct my portfolio. Well, unfortunately, the analysis is in, and I'm not sure that you want to spend too much time stargazing when it comes to picking your investments that you own in your portfolio, simply because a lot of those star ratings are highly weighted on the short-term results. We'll give you the latest. I'm going to turn and read this one. This is the latest persistence study, meaning the persistence study of how consistent the returns are on funds. And this is a study that's done every couple of years by the folks at Standard & Poor's. They found that less than half of the funds that had produced top quartile performance for the 12 months ended September 30th, 2007. Remember, they do this every couple of years, so they're looking at all of that data in the past. And so they found that less than half of the funds that had produced top quartile, so top 25% performance in the 12 months that ended September 30th, had actually finished in the top quartile for the year 2018. So top quartile based upon the ratings or the stars or whatever you're following does not necessarily show what the future of that particular investment or that particular fund is going to do. Why? Because those ratings are very heavily weighted to the 1 year and 3 year numbers. That's a short period of time. And if the fund that you're looking at had a good return or a better than average return, that's going to drive its performance. Unfortunately, the persistence of that investment approach, or more importantly, the consistency of the return, simply is not there when you start to spin it out over just slightly longer periods of time. The study by Standard & Poor's continued. When you add in September 30th of 2019, so again, they looked at the top quartile funds for the 12 months ending September 30th, 2017, and less than half actually finished in the top quartile for that then subsequent 1 year period of time from September 30th of 2017 to September 30th of 2018. And then when you add in the most recent 1 year period of time, the September 30th, 2019, only 8%. So less than 1 in 10 of the original outperformers landed in the top quartile for that third year. So we look at a 1 year period, looking at the top quartile funds for that 1 year period, and then you fast forward to the next 1 year period, and less than half of the funds are still in that top quartile for that next 1 year period, and then we go to the third 1 year period, and less than 1 in 10 are in that top quartile performance. So you can see where stargazing or rating agency fixation when it comes to your investments does not produce above average return. And in fact, you could argue with these statistics as they start thinning themselves down over just a 3 year period of time, that actually can contribute to some underperformance in your portfolio. So what I want you to do when it comes to thinking about your portfolio and thinking about the investments that you own, understand that the stars and the star ratings are just that, a guide, however, for a very short period of time. And the problem is that you've got 26,000 different mutual funds out there, the vast majority of which do not have even a 10-year track record. So it's easy for a fund without a long-term track record to get a good star rating because the star rating is so fixated upon that shorter period of time. The problem is that if you're picking a fund that has just a 10-year performance number, then you're not really seeing what that fund can do through the entire economic cycle. Why? Because this economic cycle that we're currently in has been a very elongated one. And we hear about that all the time in the media, where this has been going on for a long time. This period of expansion has been going on for a long time. The period of time when the market has been going up a long time. And if you look at the calendar, the period of expansion in the market started in March of 2009. So here's the reality. if you've got a 10-year track record or less than a 10-year track record, then you don't have anything except an expansion of the market. So chances are you should have done okay, because the market's never done anything except go up during that 10-year period of time. And that's why it's so important to look at the 15-year performance number and to find funds that have at least that. The problem is that none of these ratings will go out that far. None of these ratings will go out past the 10-year mark. So these ratings are all becoming much more nonsensical in terms of the information that they're delivering to investors. So if you're stargazing at funds and fund ratings that have a beautiful, perfect existence of a market only going up. If you go to the 15-year number, that's going to show you the true colors, because the 15-year number, performance number, and again, not a lot of funds out there have that number, so you got to screen for that first of all. But the 15-year number is going to have the full economic cycle, because the 10-year number and anything subsequent to anything shorter than the 10-year number is not going to be the full economic cycle. And it seems to me, if you really want to make good choices on your investments, then you better see how they do through the full economic cycle. None of these stars, none of these rating agencies, none of that stuff, most of that stuff is focused on the 1, the 3, sometimes the 5, but very light on the 10. None of it really takes into account 15 or 20-year performance, because there's not enough out there, to be honest. But the reality is, if you're investing money and you want to take a look at how something really has done, don't stargaze. Take a moment, do some additional research, and really look at that 15-year number, because the 15-year number is the only number, 15-year number and longer, are going to be the only numbers that have the year 2008 in them, that actually have the performance of an investment through a full economic cycle. So don't be caught stargazing. Don't be caught looking up to the heavens and figuring out the stars and the ratings and all of that stuff. The reality is that those numbers mean much less than they ever have in the past, primarily because their main problem has always been that they're very focused on the short term, but in particular, even the ratings that will actually pick up the 10-year numbers, the 10-year number is all sunshine and roses. None of them go out past the 10-year number, which means that if you're a stargazing investor, you really got to take a moment and set that aside and do some additional research to really find out the long-term performance numbers of what it is that you're owning or what it is that you're thinking about owning, because that's the important number to look at to get an appreciation of what the investment has done during the full economic cycle. So watch out for the stars, because there's not a lot of truth in those stars, particularly how something does through a full economic cycle. With that, we'll take a break. We'll shift to a break and continue the conversation here on Dollars and Cents. My name is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Howdy friends, Joel Garris here of Nelson Financial Planning. You're listening to Dollars and Cents, Central Florida's longest running radio program. On this segment of the program, we're going to talk a little bit about what is a traditional formula and how in today's world, particularly in today's world of low interest rates, you may want to be revisiting that traditional formula. The traditional formula that we're talking about is the 60-40 investment allocation. Very classic, very widely used throughout the industry if you're looking to be balanced and more on the growth and income side of things. Pretty widespread usage, and what basically that 60-40 means is that the 60 part is the part that's in stocks, so that's 60% in stocks, and then the 40 is the portion that's in bonds, so that's 40% in bonds. And so that type of balance, and that's pretty well balanced, 60% one side, 40% the other, a little bit heavier on the stock side to get growth over time, things like that. That 60-40 formula has been a very traditional approach that many portfolios are designed around. 60% stock, 40% bonds. generally viewed as sort of a middle of the road type of an approach that won't be that volatile, but still will get some level of return over time. Often thought of as like a total return type of an approach. Those types of labels would apply on that type of an investment allocation. But here's the thing. The environment that we are in, and it seems like for the foreseeable future, is a very low interest rate environment. And there's actually just recently been some studies on the effect that low interest rates have and how that plays out versus those traditional investment allocations. So this study actually comes from the Leithold group. I'm probably saying that wrong, but they look at 93 years of market data and compared the opportunity to invest in stocks, particularly when the yield on the U.S. Treasury, and the 10-year U.S. Treasury, is below 3%. And if you've lost track of where the yield is on the U.S. Treasury, believe me, I can understand that. It's the holidays and other things going on. The yield currently on that 10-year Treasury is 1.82. So well below the 3% threshold that this research looked at, looking at the past 93 years of market history. And what they saw in particular was that when interest rates are below, when the yield is below 3% on the 10-year Treasury, that you actually wind up doing much better on the stock side of things, and you do not have as much risk as you might well expect. So here's the conclusion of the study that looks at the past 93 years, and particularly looks at those periods of time where the Treasury yield is below 3%. Adding equities to a portfolio when yields are under 3% sharply boosts returns, here's the kicker, without significantly increasing overall risk. The study again looked at data from 1926 to 2019. The volatility of an all-equity portfolio is 40% lower when bond yields are below 3%. So let's translate all of that to English for normal investors. What that means is that if you're following a 60-40 allocation, because that's the bread and butter, that's the white bread of an allocation in the financial services industry, you are going to underperform relative to what you could be doing, particularly by adding more stocks to that mix. You're not, in fact, taking on an excessive more amount of risk, which is pretty important, because one thing that allocation drives, 60% stock, 40% bonds, is to try and balance out that risk, right? That's the purpose of the bond side of that equation. But the reality is that when interest rates are low, the bond piece isn't necessarily holding its own. Stocks also have a tendency to chug along because the borrowing cost is much lower when you have those lower yields. And so consequently, if you're sitting in that 60-40 portfolio today, we would encourage you to relook at that and perhaps shift that stock part up. And we're not saying go to a full equity portfolio. Of course not. That becomes way more aggressive than, at the end of the day, what most investors should be ultimately doing. But if you're at 60-40 today, you really need to be looking at 70-30 or 75-25, moving that needle out a little bit, because the reality is, in this low interest rate environment, you can actually have a little bit more stock exposure without having to take on an excessive more amount of risk than what you would typically experience because of where interest rates are. This study again looked at the stock market data going back to 1926, particularly looking at those periods of time where the yield, where the interest rates were below 3%. it almost became almost a gift, if you will, which is particularly good around the holidays, right? That if you added more on the stock side, you in fact got a much better reward without taking on that much more risk. So the message, if you're an investor, if you're in one of those kind of milquetoast, plain white vanilla type of investment allocation, 60% stock, 40% bonds, it's really time to take a look at perhaps tweaking that investment allocation, because the studies certainly suggest that you could have a little bit more on the stock side and not be taking on an excessive more amount of risk in that portfolio, and ultimately that will generate a bit more of a better return for you over time. So something to think about if you are in that kind of middle of the road type of investment allocation that's very, very popular in the investment industry. Perhaps it's time to take a second look at that. So if you're an investor and have that, we encourage you to do that. We are out of time, so we're going to wrap it up and get on out of here. Thank you all for listening to another program of Dollars and Cents here on News Radio WFLA. This is Joel Garris of Nelson Financial Planning. You can catch the program during the course of the week ahead if you check us out on any of those podcast channels or subscribe to our YouTube channel at Nelson Financial Planning if you want to catch the video of the program itself. Thank you all for listening. Have a great week out there, Central Florida.